we've talked about how to hedge a short underlying position. The basic way is to buy a call. You pay a premium, so in case the underlying rips in your face, it goes upwards again. You're going to protect yourself from your maximum loss of blowing up, along with the underlying going up as well. You can also hedge a short underlying position by shorting a put, and you're collecting a premium, and you're not protecting your upside, but you're making some money. And if the stock dumps down, well, the underlying position and the short put will vanish. You'll make some money on that short underlying position, and you'll collect that premium, put that in your trading account, and call it a day. Now you can combine those two positions, the long call and short put, and put on a risk reversal. So you're funding your upside protection by selling an out of the money put. So it kind of limits your economics. It constrains where you're going to make money, and this might be good for a position, an underlying position where you think a stock's going to drift downwards. You have a range in mind. You don't want to pay for protection too much, so you're willing to give up excessive downside moves for the fact that your upside is covered and you didn't really pay for much. Also, with the risk reversal, because of the structure of a volatility curve, puts are generally more expensive than calls if they're equidistant to the at the money forward price. So what this is saying is you could protect yourself and receive a credit for doing so for many underlyings. If you put on this trade, you're going to obviously change your P&L characteristics of your portfolio. You're not just short stock now. You're not just short stock and long a call. You're not just short stock and short a put. You're short stock, long a call, and short a put. And ta-da, through the miracle of options, this here looks like a long put spread. Now, you ask yourself, why not just buy a put spread? Well, I mean, the point of this trade was to hedge your short underlying position. It wasn't to buy a spread that could decay to zero. It's for portfolio managers possibly that like to have short underlying positions and they just want to protect themselves. Again, you can roll this position down, or actually you'd be rolling it up if for risk reversal. You can roll your position up. Say the underlying rips in your face, your long call is going to go up in value possibly dramatically, and your short put might go down to zero. Well, you sell out your long call. You might buy another higher call against it, and then likewise with the put, you buy back your short put, you sell out another put, and roll that position. So these are things that you can do and you should do given the fact that the whole point of the risk reversal was a hedge to your short underlying position. And again, that's the takeaway. When you're hedging something, you're going to need to close out that hedge in order to actually realize the money that you made. And that money is real. It's going to pad your P&L. It's going to pad the original portfolio. In this case, that original portfolio was being short and underlying. So just remember that if you're going to go ahead and execute a risk reversal trade.